Hello everyone, this is Pattu from freefincal, and in this video I'd like to discuss how new stock investors can benefit from low volatility stocks. So one of the biggest problems that new stock investors have is how do I choose which stock, and they worry if their choice will lead to big losses and so on. So let's first talk about what is low volatility stock investing. Does it work? Is there proof that it works? And is it actually possible to get higher returns at lower risk? Now, low volatility stock investing essentially means that you take a well-known index like the Nifty 50 or let's say the Nifty 100. So that's a basket of 100 or 50 stocks, and from those stocks you choose only stocks over the past 1 year has exhibited extremely low price volatility. That is, the price does not move up and down so much, or there's no violent price fluctuations, and this is measured via what is known as the standard deviation. So you only choose stocks that have extremely low volatility or low standard deviation. And the reason, I'll show you proof that it works, but the reason why it works is that if you choose low volatility stocks, you're basically protecting the downside fall, how much your portfolio falls when the market moves down. And that is essentially why it's successful. And so we will look at three different indices, and if you look at the Standard and Poor's, the S&P, they maintain as many as 24 low volatility indices from across the world. The Nifty, the NSE, has got 2 low volatility indices. The BSE also has 2 low volatility indices. This whole idea of low volatility investing is catching on, and if you, of course, the actual index with real-time trading, the history is quite low, but it's just last few years and so on. But if you you can backtest with the data that has been calculated with past portfolios. So what you see here is the Nifty low volatility 50 versus the Nifty 500. Both of them are total return indices, that is, the dividends are reinvested. The Nifty 500, as you all know, has the 500 stocks with the highest market capitalization, free float market capitalization, that is freely tradable shares. The Nifty low volatility 50 is 50 stocks from the top 300 stocks in terms of market capitalization. So out of 300 from this Nifty 500, the top 300 is chosen. Then from that, only 50 stocks are taken. 50 stocks with the lowest volatility are considered. So that's how the Nifty low volatility 50 is created. So what you see is the 10-year rolling returns of the Nifty 500 TRI and the Nifty low volatility 50 TRI. So there are about 1,200 data points in the Nifty low volatility 50 black curve. That's the black curve, and the red curve has got slightly more than that. That's the Nifty 500. You can see that consistently the no volatility 50 has got higher returns than the Nifty 500. And at the bottom you see the rolling risk or the rolling standard deviation of the index. And you can see in this case, the lower the standard deviation, the lower the risk. And you can see that the Nifty low volatility has always been having lower risk than the Nifty 500. So this is what I mean by saying that you can get higher return than at lower risk. So you can take lower risk and still get higher return, and that's essentially the whole idea behind low volatility investing. So this is the case for India. Now if you look at the case for the USA, everybody knows that S&P 500 is one of the most popular broad market index in the US. The S&P 500 low volatility index is created by taking 100 stocks from S&P 500 which have the lowest volatility. And if these are 7-year returns that you see. Excuse me. These are 7-year returns on the top, and the rolling returns are seen. About 760 7-year returns are seen, and you can see that typically that there's no clear winner, but you can see that the low volatility index matches up to the S&P 500. It doesn't always beat it. Sometimes it underperforms, but it does match up to it. And you can see that the fluctuations in returns are also not as much as the S&P 500. And also the rolling risk that you see in the bottom, that is always less. So you're pretty much guaranteed low risk, and you could get a return that's close to the S&P 500, or a bit more or a bit less, depending on when you start investing. So it seems to that's reasonable performance for a developed market like the US, but it has given good performance for a emerging economy like India. And now we have the S&P Emerging Market Low Volatility Select Index versus the S&P Emerging Plus Large Mid Cap. So this consists of about, if I remember right, 50 stocks from this S&P Emerging Plus Index. And this S&P Emerging Plus has got stocks from 36 emerging countries, emerging markets over the world. And you can notice that if you again look at the 7-year rolling return, the low volatility index has done extremely well. The outperformance is significant. So it seems to be performing very well in the case of emerging economies than in the case of a developed economy like the US, but it's still fine in both cases, I would say. Again, the risk is low at all times. So that's why I keep saying that low volatility stock investing works, and it's a fantastic idea to pursue. And the reason why I suggest it to new investors is because, look, there's always a doubt, which stock should I choose, how should I choose, and so on. But if you choose low volatility 50, you don't need to worry about balance sheets. You don't need to worry about whether the value is right or wrong, high or low, or undervalued or overvalued. You don't care about that. You're choosing a value stock or a growth stock. It doesn't matter. You're just choosing stocks which have low volatility. And essentially, if you actually look at it, only a solid company which has got which has got good books, which is a clean business and is valued by the investors in the market, only such companies will have essentially low volatility. And this is the October 31st fact sheet of the Nifty Low Volatility 50. You can see the sector representation on the left and the top 10 stocks by weightage. So in the case of a low volatility index, the stock which has got the lowest volatility will get the highest weightage. Right, so you can see those stocks there. They're all solid stocks. They may be a little expensive if you're just starting to earn and so on, but you can always accumulate some money and buy it. And so you can just buy from among this, and just accumulate one stock, two stocks, whatever you can every month, and slowly build a portfolio. This can be your core portfolio. Many investors make the mistake of chasing after multi-baggers, chasing after mid-cap, small-cap stocks, and they burn their hands. Don't be in a hurry to make money in stock investing. What's the hurry? Let this be your core portfolio, right? These are good companies. You can always play with mid-caps and small caps in your satellite portfolio. That's like 20 to 30% of your equity stock portfolio. You can play with that. The rest of it can be the core, and this will, withstand market ups and downs, and over the long term this will benefit. You cannot expect most of them are actually already multi-baggers if you actually look at it, but that doesn't matter. You don't need to choose all the time potential multi-baggers. You can choose an existing multi-bagger and still make good returns. After all, for these companies to survive and generate profits, they must create profits which are higher than the existing rate of inflation or the existing borrowing rate. So there's no danger of choosing these stocks, except that you should give them some time to pay you back. So that is the reason why I believe that low volatility stock investing is wonderful for new investors, and there's enough evidence that it works. So I'll catch you again in another video. Bye bye.